this is Shaheedah Hill, the Real Realtor, getting you over the hill to home ownership. And there's one number that I want to make sure that all of my home buyers know before they get pre-qualified for a loan. No, it's not your credit scores, even though those are very important. It is your debt to income ratio. Most lenders call it your DTI. What is your DTI? How to calculate it? I'm going to give you an example today, and then I'm going to give you some resources to calculate yours on your own. So the first thing is you have to know how much you make. So I'm going to give you an example of somebody making $50,000 a year. So you take whatever you make, your salary. If you're hourly, you want to add that up, or you want to look at your last tax return or your W-2 from this year, and you want to divide that number by 12. So whatever you make on a yearly basis, divide that number by 12, and that will give you your monthly gross income before any taxes are taken out. That's what lenders are looking for. They're looking for your monthly gross income to try to determine if you can afford a mortgage payment, okay? So you need to know how much you make every month before taxes. So divide your yearly income divided by 12. That's going to give you your monthly, or you can just take your last 30 days of check stubs and figure out what you're bringing home on a regular basis every month. Okay, once you have that number, and for our example it's $4,167, once you have that number, I want you to figure out what all of your debt payments are. So let's go over this debt. So for this example, this person has a Discover card, and the minimum payment, so you don't have to do the entire balance, but you need to know the minimum payment usually on your debt. So that's going to be $75. Then this person has a Visa card, and that is $100. And that, again, is minimum payment. Don't worry about the balance. What's the minimum you have to pay every month to keep that account in good standing? So next is a car payment. This person has a car payment of $400. And then lastly is student loans. Now I'm going to do a whole new video on student loans, but this is assuming that you have a $350 student loan payment. Now, if you're like on any kind of income base, so just really quickly, if you're on any kind of income-based plan, you're not paying your full amount, something along those lines, then some lenders, particularly for FHA loans, will take 1% of your loan balance. And that will bring your debt to income ratio really high, because they never know when you're going to get out of your repayment. So please like and subscribe to my channel. I'm going to do a whole thing separate on how they calculate student loans into your debt to income ratio. But for right now, I want to make sure you understand how to calculate your debt to income ratio in the first place, okay? So the student loan payment is $350. So the total debt that this person has is $925 total debt. So if I take that total debt, I'm going to divide it by their total gross monthly income, and that's going to give me a debt to income ratio of 22%. So this person's debt to income ratio is 22%, which is pretty decent. However, they want to buy a house, so that's going to increase their debt to income ratio, because now they're borrowing money for a mortgage. Now, most lenders want to see debt to income ratios between 36% and I would say low 40s. So say 45. You may find a few loans that will go up to 50, but that's rare. So we're talking about 36 to 45, depending on what kind of loan you're doing, okay? So you want to make sure you're 36 is ideal. Some lenders will go like 41, 43 when you include because they're going to determine, okay, with all of your bills, do we think that you can also afford a mortgage? So for this example, this person wanted to add to their debt $1,250. That's about a house that's about $200,000. You might pay about $1,250 a month. So can they afford that? Like, can they do that and still keep a low debt to income ratio? So when I add this $925 to the $1,250 anticipated mortgage payment, that's going to bring me up to $2,175. And I have to do the same thing. $2,175 divided by the 4167, guess what? It gives me a 52% debt to income ratio. That's high. Some lenders are not going to give you a loan on that debt to income ratio. So what happens now? Can you get a house? Probably, but not for $200,000. That's when they're going to try to pre-qualify you for less. So they might pre-qualify you for an $800 mortgage, a $700 mortgage, because that will bring your debt to income ratio, and move this a little bit. That's going to bring your debt to income ratio at 41%. $700 mortgage is 39%. So it's very important that you understand how to calculate your debt to income ratio. All it is all of your debt payments divided by your gross monthly income. Again, it's all of your debt payments divided by your gross monthly income. Please calculate this number. Know what this number is before you get pre-qualified. Please like and subscribe to my channel, so for next week when we go over student loans, if you have any student loans, you'll know how that's calculated for all of the loan types. Remember, only 4 types of loans: USDA, VA, conventional, or FHA. So you need to know how your student loan debt can affect or impact your ability to get a mortgage. I'm listing down below a bank rate debt to income ratio calculator for you to use to make it super easy, so you will know your debt to income ratio. If you have any questions about calculating your debt to income ratio, please put it in the comments. If you're married, you put both of your debt, both of your gross monthly incomes together to determine what anybody that's on the loan, you want to put that information together, all the debt, all the income, and then come up with a combined debt to income ratio. Thank you so much for watching. Please like and subscribe to my channel. If you're a first-time home buyer, I have lots of videos about the process. Please like and subscribe.